The threat to Australia's AAA credit rating took the edge of the share market, but shares still finished higher and the Australian dollar remained resilient. Here's Philip Lasker.
We know credit ratings agencies are unimpressed with our debt reduction efforts. Now we're on probation. Other AAA club members are cutting debt more quickly than Australia, and Standard & Poor's doesn't like our chances of catching up given the election result. The ratings agency doesn't want to see a deterioration from the paths already laid out by the Coalition and Labor. But economic basket cases like Spain and Italy can still borrow more cheaply than us because of their EU link to Germany. This is even more important, the terms of trade or the value of our exports relative to the value of our imports. The downgrade could come sooner rather than later if this continues deteriorating. Standard & Poor's has already penciled in an iron ore price of $35 a tonne. That's more than 30% below current prices. Of course, this threat will be revoked if the trade performance or the budget outlook improves. Anything's possible, I guess. Markets were relatively unfazed. The Australian dollar took an initial hit, but it's not a downgrade and it wasn't totally unexpected. The dollar is lower across the board, but only slightly weaker against the US currency. The share market hardly missed a beat. Wall Street's positive performance trumped the downgrade threat. Resource shares led the market higher after the S&P announcement capped gains in bank stocks. Because of the government guarantee, a cut in the credit rating means downgrades for the big four banks and higher funding costs, which leads to higher mortgage rates. But the real downgrade happened to online retailer Kogan. It listed today and plunged 16% on its float price, and that's finance.